Welcome everyone to Australian Catholic Superannuation Fund's annual investment update. Tonight we have with us Michael Block, who is our Chief Investment Officer, and I'll come back and introduce Michael in a moment before he talks. Tonight we have also with us Justin Colley from our Sydney office. Justin is going to be behind the scenes in the background, hosting our chat facility. So during the presentation, if you do have any questions that you would like to ask, Justin will be there and he will come on at the end of the session and take us through some of those questions. Tonight we have taken away your microphones and your video content, so we've turned those off just simply and purely for minimising the distractions and the background noise for tonight's session. If you would like further information, Justin will be keep an eye on the chat facility. Justin will be pushing out some feedback forms through that facility where you can click on a link if you want some further information. Just for registration purposes tonight, we've got a number of people who have thankfully got their names listed, but for registration purposes, Justin will be making contact with those people that haven't got a name, maybe just have a number or some initials, so that we can confirm that you've attended, so that you'll be receiving the feedback form and also further information that we push back through. So thank you all very much for coming tonight. My name's Paul Lynch. I'm the Regional Manager for the Brisbane office of the fund. I've been with the fund for a number of years. I won't go into the number, but it's been a long time. But certainly in recent times, in the last week, we've had an exciting announcement that has been made. And tonight we can advise that our membership, that we have entered into an agreement for an in-principle merger with the Non-Government Schools Superannuation Fund, or NGS Super. That merger will be taking place late next year or possibly early 2022. The one thing that I would say is that at this stage we've just signed a memorandum of understanding, but the coming together of two education-based funds that share same values, culture, and pretty much history will be an exciting feature for our membership going forward. We will be providing a great deal of information down the track. Michael, if you could move to the next slide in regards to the merger. We do have a website page that you can go to seek further information, and we'll be pushing further information when we know more. Obviously, there's a great deal of work to do to bring these two funds together, so it's certainly exciting times in the history of the fund. Tonight's session, if we move to the next one, Michael, in regards to a disclaimer, Michael and I, we always have to laugh at about that we've got to keep our compliance and audit people at bay. We do need to share this disclaimer with you. So tonight's session is just simply and purely factual information. We're operating under a license. We can provide you with a product disclosure statement and financial services guide. That's all contained on our website if you wish to get that further information. But certainly it is available. Tonight's session, whilst we can't offer advice as such, we've just got to keep it of a general nature. We do hope to take you through what is going on in currently being witnessed within investment markets. So today's session is being run by Michael, who is our Chief Investment Officer. So Michael has been involved in financial services sector in Australia for over 40 years. He's held a diverse range of positions in investment banking, government and funds management, such as Number One Super in PNG, Super Plus Financial Services, WorkCover New South Wales, and also the University of New South Wales. Currently holds, as I've mentioned, the position of Chief Investment Officer in our organisation, which really is the person that's responsible and looking after our members' funds. So Michael has undergraduate qualifications in law, accounting, finance and philosophy, and postgraduate qualifications in law, applied finance, economic history and economics. On a personal note, Michael was born in Johannesburg, South Africa. He still holds his English citizenship, but I'm pretty sure his loyalties now lie with the Australian, our far superior cricket team. He is married with 4 daughters ranging in ages 12 to 30 years. He enjoys playing and watching sport, and unfortunately is an avid supporter, and you can witness that in the background of tonight's video, that he's a supporter of the Sydney Roosters and the Liverpool Football Club. On a fund level, his mother was a teacher, together with his eldest daughter, so he's in no better position to understand the needs of our membership base, having also just recently passed the preservation age, and he always openly admits that. Preservation age is when you can have access to your money within superannuation if you genuinely retire. So he admits that quite openly in conversation, and he knows, so therefore he understands what people are looking for close to retirement, and certainly those within it. Michael certainly loves a conversation. We often meet together. When pre-COVID, we were travelling around and meeting members face to face, and he enjoys getting to know members and hearing of their issues in terms of investment. So tonight, Michael, thank you very much for attending tonight, and if you can fire away with what's currently being played out in the investment markets.
Thank you very much, Paul, and good evening, good afternoon, ladies and gentlemen, and thank you very much for having me. This is actually my favourite part of my job, which is normally travelling around the country and getting to meet you all, but I'm afraid all we've got for today is to do it remotely. As Paul said, don't let my baby face deceive you. I'm actually 58 years old and can take my money out of super once I retire. And so a lot of the things that you're thinking about, I'm thinking about exactly the same sorts of things. Will I have enough to retire? How long will my retirement savings last? And those sorts of questions. And as Paul mentioned, my family's in education, including daughters, mothers, wife, and even me who worked for university for a long time. So I appreciate a lot of the things that you're thinking about and hopefully can share them with you now. Let's start with the presentation. Please remember that at the end, you can send your questions, or if you think of them along the way, send the questions in to Justin. We'll answer those that we can tonight, and any that we can't get round to, myself or one of my colleagues will personally answer you after the event. Now, I'm sitting here alone in the office, one floor above Justin, and it's a bit eerie, and I'm sure that this brave new world and what's happening is very different from what you're all used to. The last year has been one that has been horrible, and I'm sure one that you'd all rather forget. We've had droughts, we've had floods, we've had bushfires, we've got coronavirus, massive unemployment, uncertainty, a US election, all sorts of things on the horizon. And with this great uncertainty has made it probably the most difficult year that I've ever had to face in investments. I don't really think anyone could have anticipated the speed and severity of COVID-19, but I'm very pleased to tell you that your fund handled this crisis better than most. Late last year, and even into January this year, we thought that prices were very high by historical standards. You'd know that your own houses were fetching high prices. You saw the share markets were near all-time highs and very crazy prices for the technology stocks like Apple, Netflix, Google, Alphabet, etc. With that in mind, we made our portfolios as safe as we could, because it's our aim in life to grow your portfolios as safely as we can. And we tried to move away from some of the expensive asset classes and to take some precautions. So with that in mind, we reduced our equity exposure, and even within the equities, reduced our exposure to those very expensive technology stocks and increased our exposure to Australia and emerging markets. We bought some additional government bonds, and the reason why we did that is every time there's ever been any form of market downturn, interest rates have fallen and bond prices have risen, which means holding bonds is a good counterpoint to holding equities. We increased our US dollars for the same reason, and we even held some extra cash, mostly so that we could take advantage of future opportunities should they arise, and they did. All of these things helped us reduce the effect of COVID-19 on our portfolio. To give you some examples, I've got some pictures here just so you can see how short, how sharp and how severe the downturns were. This is a chart of the Australian share market. It's a 1-year chart, and you can see everything was chugging along happily until the end of February, beginning of March, and then a massive downturn, and we've recovered about half of it. So the share market's currently around 6,000-ish, but it got as high as 7,200. The story is very, very similar for US shares. Couple of minor differences. The market didn't fall quite as sharply, even though the picture looks the same. It's just a scale difference. And the US shares are actually, as of today, at an all-time high, whereas in Australia, we've only recovered 3/4 of it. This chart's only up to the end of June, so we're a couple of months on since then. The Australian dollar behaves like most risk assets, and that is that when times are good, the Australian dollar is high because trade is doing well. We're selling our goods overseas. Industrial production is high and people want to buy our iron ore, our coal, and things like that. And when times are bad, people sell Australian dollars. So a very good strategy you can have, and we had, was to hold more US dollars in preparation for a downturn. What you can also see there is with the Australian dollar at 71.75 this morning, we've actually surpassed the highs of January, but that's not because the Australian dollar is doing so fantastic. It's more got to do with the US dollar is doing particularly poorly. Interest rates. These two pictures represent on the left-hand side what interest rates have done over 1 year, and you can see they're all over the place. So I'd rather you concentrated on a longer-term chart of interest rates. And this is a 10-year one on the right, and you can see that interest rates have fallen now to the extent where a government bond for locking your money away for about 10 years is around 1%. And you're probably seeing the rate that your bank will give you on a bank bill or on your savings accounts are probably around 0.5 to 0.75%. This can be good news. This can be bad news. It's great news if you held bonds and property and things like that, because the falling interest rates force asset prices higher. But if you're someone like me who's thinking about retirement in the future, it's bad news because it means that you probably need additional money to retire on, because whatever capital sum you have, it won't provide anywhere near the retirement income that it used to. For those of you that are of my vintage, I'm sure you will remember purchasing your first home. When I did mine, my interest rate was 17.5%, and today my home mortgage rate is between 2 and 3%. So a very big difference. So let's have a look and see how our fund performed. First and foremost, as I said earlier, no one really saw this coming, and it hurt all assets. So really the best I can say is that if you're in individual strategies, we protected you better than most for two reasons. Firstly, the precautions that we took in place meant if you compared us to other funds that are doing exactly the same thing, we did better than average. You can see that a growth fund, we're about 1.5% better, a balanced fund 1% better, and that's just for those 3 months of downturn. So the portfolio design that myself, Chris Drew, who's also on this call, and our head of equities and the rest of our team put in place was something that gave you better protection, but also helped you on the upside as well. Our approach was two-pronged, however. Not only did our individual strategies do better on a like-for-like basis, but also we have a life cycle strategy as our default fund, which meant and means that as people get older, we put them into safer, lower risk strategies. What that's all about is it means my 28-year-old daughter can afford to hold more shares and more property because she's got 50 years to catch up any losses and a long time till retirement. Someone like me, it's probably got less than 10 years to retirement. I need to have safer assets because I can't afford to have a large loss when I've only got a shorter period to catch it up. So once again, our approach was twofold. Firstly, to make our portfolios safer, but also to put our older members in safer portfolios by virtue of their age. That's what a life cycle strategy does. Here's some numbers to show you just how effective that strategy was. The average balance fund that you'll see in the surveys and other super funds for those 3 months lost about 9.3%. And depending on your age, you lost considerably less than that. So let's just take a 60-year-old. If you were in lifetime one, you would have lost about 6.3%, a full 3% better than the median balance fund, and even better if you were older. And that's the beauty of a life cycle strategy. It means that we protect our older members, and when you're that close to retirement, that is extraordinarily important. Since COVID, we've had to make some changes because the settings that we spoke about, such as buying Australian dollars and buying bonds, were great for a while, but then circumstances change. So it's no good just holding less shares, more bonds, etc. We have to do things and adapt with the changes. And the reason that we do that is because if things offer better value, we're prepared to hold more of them. And if things are expensive, we probably want to hold less of them. So around the 23rd of March and beyond, we did a few things that actually undid some of the protections we put in. We reduced our bond holdings because we took the view that interest rates were just so low that they were not a great thing to hold lots of in your portfolio. Just as an aside, if one holds bonds, I can guarantee you that you'll get your money back and that it's the lowest risk investment. Unfortunately, I can also guarantee that it'll make such a low return that your savings will get eaten away by inflation, taxes, and fees. So they're not a great asset to have in a superannuation fund. Additionally, as the Australian dollar got as low as 55 cents against the US dollar, we bought some Australian dollars and we've been steadily selling those as the Australian dollar has risen to its level of now about 72 cents. We bought some equities in March because they were cheaper. And again, as the markets got more expensive, we've sold a few of them and taken some profits. And we've increased our exposure to credit markets, things like hybrids, lending money to small and medium-sized enterprises, debt and credit strategies in other countries, emerging market countries, because they offer better returns. But the reason why we did that predominantly was because bonds and equities just looked expensive and we wanted to try and diversify the portfolio, make it robust, and make it the sort of portfolio that could navigate whatever happens in the future. I'm sure you're all very interested in how the fund has performed, and I'm pleased to tell you it's pretty good. If it's okay, I'll start at the bottom because that's the best picture, and that is our secure and capital stable strategies have been way better than average and top quartile and occasionally second quartile for most of the last of its 10 years. And our conservative balance strategy, which is what used to be the strategy all our default members were in until we moved to life cycle in May 2018, it's doing okay as well. Over the last 3 months, which by the way was an up market to June 2020, we were top quartile, nearly 1% higher than average. And if you go all the way out to 10 years, we're about average. And that's even after fees and taxes. So we're very, very happy that we can say that we protect people in the downturn, our long-term performance is average or better than average, and that we protect our older members more than our younger members, which is great news for those nearer retirement. For the record, I've put some 3-year performance numbers up. And as you can see, our balance fund is slightly behind average at 5.07, but I hope you'll forgive me 0.1%. And our 3 other funds, Capital Stable, Conservative, Balanced and Secure, are all doing very, very well and well above average. Now comes the most difficult question. What happens next? I must tell you that I'm a little bit surprised at how high the markets have recovered in various countries. In the case of the US, as you saw in the chart I put up, some prices have gone beyond where they were in January. And in Australia, we've recovered, 2/3, 3/4 of what was lost as a result of coronavirus. I really don't understand that. And the reason I don't understand it was I thought prices were expensive in January, and now we've had a massive economic, social, and a health shock. There are people who are sick and dying. There's masses of people unemployed. I'm sure you all know family and friends that have experienced hardship as a result of coronavirus. And so I can't really understand why prices are as high as they are, other than maybe the low interest rates are forcing everybody to buy growth assets because they really have no alternative. There's an acronym that describes that. In fact, there are 2 acronyms, TINA and TRINA. They're not old girlfriends of mine. They actually stand for there is no alternative, or there really is no alternative to buying property and equities and assets like that in an attempt to try and have a retirement income. And I'm very cautious and very scared that this might lead to asset prices going up too high, even maybe getting into a bit of a bubble, and then at some stage in the future leading to another downturn. I think the reason why all these prices are going up is also that I'm sure you've seen on the news that companies like Moderna and institutions like Oxford University think that vaccines may be on the way. And when these come about, it'll be better news for the country, all countries, and people are sort of looking over the cliff and looking across the horizon and seeing that eventually things will recover. I personally think that's a touch optimistic, but I definitely believe that the worst is behind us in terms of share price losses when we're at March levels. But most importantly, I do think it'll take a long time for our weakened economy to return to normal. To give you some examples, I don't know how many of you have thought about it, but I'm not going to be traveling on a cruise ship or overseas on an aeroplane anytime soon. I'm much more cautious about doing things like going to the supermarket and going to restaurants. And some of the restaurants and establishments that have experienced troubles in the past, I think will be slow to open or may not even open again ever, but we'll see. So if you find yourself in this situation, what should you do? Well, first and most importantly, what I want to say is that what you saw happen in those 3 months of February, March, April this year was certainly an aberration. And if you have a look at a long-term chart of US shares, you'll see that they recover much better in the long term. And even after this blip, we're still seeing reasonable numbers. So these are all charts using the same data. The one on the right is 5-year US shares, and the one on the left is 30 years of US share price history. And I think the point that I make is that if you're prepared to find the right strategy and to hang on, then time will take care of most of these things. So you'll hear phrases like staying the course, and I think that's a very important thing to do. I'd also say to you that with the markets having recovered a great deal, this gives you a great opportunity to reassess your position. If the market downturn that you saw here scared you and you thought, I don't like those sort of risks, then now's a time to move to a strategy that doesn't have that sort of volatility. And with that in mind, there are lots of things you can do. The best thing you can do is to make an appointment to see one of our award-winning financial planners and get a customized, tailored portfolio. The second best thing you can do is get some intra-fund advice, which is free, by the way, by calling our call centre and having a chat. And even if you don't wish to avail yourselves of that, and given that you're on the call today, I can tell that you're some of our engaged members. But for those of our members that aren't very engaged, hopefully Lifetime One will do that automatically for you. It'll put older members into a safer strategy so that they have peace of mind as they get older. That leads me very nicely into letting you know what sort of financial advice options you can have. I've mentioned them very briefly, but now I might hand you over to Paul Lynch, who can tell you a little bit more about them and how you go about registering for them.
Lovely. So thanks, Michael. Just before I go through that, just like to remind people that if you do have any questions, there's the chat facility. Justin Colley is there to take those questions, and he'll be coming up in a moment with those and asking Michael some of those questions. Michael's briefly mentioned the service feature of the fund. We'll be soon forwarding out a link via the chat facility where you can indicate if you want further information from the fund. There's 3 portals, so certainly there's the general advice. So I will provide you with our 1300 number in a moment, but the call centre or any regional office staff are available to provide you with general information on our product offering with the fund. Michael mentioned that if you want to have your first appetite of receiving advice, we do have advice over the phone. It will cost you essentially 30 minutes of your time. It will mean that they will be able to review your scenario, what Michael's been talking about, your investment profile, and basically put you into a profile that will put you then into a portfolio that suits you for the longer term. I think it's a fantastic introduction to the area of financial planning. And these conversations over the phone can certainly guide you quickly. But investment advice is not the only issue. They can certainly look at insurance and contributions as well. If you do want to seek face-to-face or have a personalised advice done, maybe for yourself and your partner, the financial advisors that we have with the fund can provide you with strategic advice. So they bring all together your whole gamut of financial assets, liabilities and the like. They look at your income, your expenses, bring them all together and design a portfolio that suits you for the longer term. So when you do get that link, you are able to click on that link and provide an indication of which one you would like. So certainly that is available there for you. The next slide, Michael, is in terms of our member portal. The member portal over the last year has certainly had a number of updates provided to it. And I will say that I sneakily check in there, have a look at times. So certainly having a look at your account balance, you can change your investment options. The one thing is that you can have a look at your investment earnings and see how your portfolios have performed in the year to date. More importantly, you can have a look at and amend some details. But certainly by keeping it and having a look at that member portal, you will certainly see some movements in your account. I always tell people sometimes it's best to not look too regularly, and always be seated. So sometimes there is a shock because we are talking about daily unit pricing. So your account balances do change from day to day, but certainly having a look. I have a range of members that sometimes are too scared to look, or some others that are just look every day out of interest to see where the markets have gone. So certainly that is available, and I encourage you to just go onto our website at www.catholicsuper.com.au, whereby you can just go and log in, or if you haven't logged in previously, you can register. You'll just need to go through the security steps. If you've got any problems with that, I'm sure the 1300 staff will be available to assist you there. After tonight's session, if we go to the next slide, Michael, after tonight's session, we will be emailing you a feedback survey that we really do appreciate comments, questions, and the like in regards to the services and features, especially tonight's webinar. So we certainly appreciate that. That will be forwarded to you some stage during tonight. If you've got any questions, as I've mentioned, there's the 1300 number and our email address. Justin, I might switch to you now in regards to the questions that you've received. I'm presuming that you're still accepting questions.
Yeah, thanks, Paul. We are still accepting questions. We've got a few that have come through so far, but first of all, I just want to apologise. A few members have come on a bit late. We've had a few technical difficulties allowing some members on, so I do apologise for that. But we will, we have recorded today's session and it will be up on our website, and we'll send links to everybody who's here today, who registered for today, so they can replay this one in case you missed anything. But the first question that we've got is, what is the best strategy for me? I'm 70. Michael, for you, please.
Well, that's a very interesting question. I'm 58, so I still have 12 years to get there. But I think the best strategy for a 70-year-old is certainly one that is lower risk than our conservative balance strategy. And the reason is, notwithstanding that I've spent way too much time looking at actuarial tables, and I wish the member lives a long and happy life, but the odds are that that member's going to live into their 90s. So they've got to provide for 20 to 30 years of retirement. So I think it would be a strategy that provides the best income at the lowest risk. We've been developing something along these ways with our new Retire Smart product, which is one of our retirement products, which is a good option for that person. And I'm going to now take a line out of what Paul Lynch would say, or one of our financial planners like Tom Rouse, and that is, find the right mix of risk and return that suits you. I think we're aiming for an income of something between 4 and 7%. And by all means, supplement that with the age pension, because most people, I think the number is something like 85 to 90% of our members will get some form of supplementation down the track. But certainly it would be a strategy that's more conservative than just great chunks of shares and properties, because I think they hold a bit of risk right now. Just one thing before you move on to the next one, Justin. Just so you know, and everybody knows, the income from dividends and rental and things like that is much more stable than the share market. So if you're prepared to hold a basket of assets and think of it as buying an income stream, that approach will hold you in good stead, especially if you don't look at your account balance too often, because it might sometimes scare you a little bit, especially the last 6 months or so. Thanks, Justin.
Thanks, Michael. We also should say that Chris Drew's online as well, and his picture's there as well. Chris is part of Michael's team and can help answer questions too, if Michael puts any his way. So the next question we've got to come along is, there's been no mention of how my conservative portfolio is doing. Michael?
Conservative portfolio?
Yeah.
I think it's there. It's just that we've done some name changes. So, Chris, can just confirm for me that Capital Stable is what used to be called conservative?
Yeah, so Capital Stable is the name of this survey, and our conservative option fits within that Capital Stable survey.
So there's the numbers over 3 months out to 10 years. The return has been about 5.2% for 10 years, and just about every period we're very near the top of the class. So one of our colleagues that isn't with us today, a guy called John Fokos, is our portfolio manager for credit and bonds, and it's a credit to him especially that we've done so well in this area. Does that answer?
Yeah, Michael, I would probably also say to the members that if they want to have a look at the June returns, they are listed on the website there. They can actually see the 1 year through to 30th of June. Whilst it doesn't have medians there of other funds, but we have on our website at the moment the June returns listed for all different periods of time, and that's not only just for the super fund but also the pension product as well.
But to give that member who asked the question an example, looking here at the 3-year number, but I can go all the way out. But the last 3 years, when returns have been very difficult to come by, to make an extra 1% better than average is something that we're very proud of. And even though it's only a small increment, because 1% doesn't sound that much, when you make an extra 1%, the value of compounding makes that very valuable. Thank you, Mr. Justin.
Thank you, Michael. The next one is probably for Paul, actually. That's one question. Why can't binding nominations continue instead of having to be resubmitted every 3 years?
Yeah, for sure. There was part of the legislation that came out that was that they were limited to the 3-year time. The reason why our fund has adopted the 3-year time frame, though, is that people's circumstances change. Our life changes, and therefore we do ask people to re-advise the fund each and every 3 years to reaffirm this binding nomination. Obviously, a binding nomination has the effect that your funds will be paid to that person or to your estate at that given point in time upon your death. So it's quite a very critical and important document. And that's why our fund for security for your funds are asking members to do it each and every 3 years, simply and purely just in case if your circumstances change and you forgot to advise the fund, then we could be in a position where monies are going to the people that we might not want to. So certainly that's how I would say that one for Justin.
Thanks, Paul.
Rest assured, though, I would mention that we do strive to remind people prior to them expiring that they should receive a letter or an email saying that they can renew those binding nominations as well.
Yes, we certainly do. And the previous question that was asked, the ladies said thank you for that answer, Michael and Chris. The next question is, I am 50 years old. Which strategy do you recommend?
So that's a little bit of a tricky question because I shouldn't really be giving advice like that over the phone. What I should say is if you're 50 years old and you want to know what would suit you best, I think it'd be worthwhile giving our intra-fund advice line a call, spending the 30 minutes, have a cup of tea and work out what suits you best. I can give you some guiding principles, though, that are only of a purely general and hypothetical nature. I think that when you're between 50 and 60, as I am, I think a middle of the road strategy makes sense. And if you were to look at our lifetime one strategy, a 50-year-old would be in a strategy that still has a decent swag of growth assets. Because as I explained, if you just hold the really safe stuff like bonds and cash, you'll be guaranteed to make a negative real return in the future. And at 50 year, I'm still touch wood, you're going to live for another 40 years or more. So there's plenty of time to reap the benefits of compound returns. And it'd be, something that's not too heavy with growth assets, not too light with great growth assets, but just right. But I think I'll leave the individual one of our excellent strategies for you to confer with our advice line or a financial planner.
And just on that, Michael, as Paul said a bit earlier, I have sent a link out through the chat facility that people are asking these questions. And if anybody wants to contact the financial planner for financial advice or a limited advice team, you can click on that link and put your information there, and the fund will contact you tomorrow to make an appropriate time that suits you to see somebody. So the next question is similar along the same lines, actually, Michael. I am 65 years old. I am retired and receiving a pension via Retire Choice, conservative balance. Should I move to Lifetime One?
That's an easy question to answer, because if you're in retirement, Lifetime One is not available yet. Lifetime One is only a accumulation product. However, I would urge you to call our helpline and see whether our current offering of Retire Smart might suit you. It may. And what I might do now is pass you on to Chris Drew, who can update you on the changes that we're making to Retire Smart to make it suitable for people with all different risk appetites. So Chris, over to you.
Sure, thanks, Michael. So Retire Smart is, and again, we would advise before you just put your money into Retire Smart, speak to somebody at the fund to find out more. But at the highest level, Retire Smart uses a two-bucket approach, which takes growth assets and cash. That cash bucket is used to pay your pension payments, and we stick to around 2 years worth of pension payments in that. So you can sleep at night very comfortably knowing at all times you have 2 years worth of pension payments sitting there. And the growth assets are used to generate enough income to replenish that cash bucket, which then obviously cycles out to continue those pension payments for as long as possible. So look, as a conservative balance member, I think they said that option, it would probably resonate quite well. It's a similar risk profile. It operates reasonably similarly, only we have this cash transferring mechanism, which means that we have a very stable income payment to the retirees within that product. So yeah, please give the call center a call, ask them about Retire Smart, and they should be able to help you, whether it's with some intra-fund advice or whether it's to a more comprehensive plan. But that would be yeah, worthwhile doing.
Thanks, Chris and Michael. The next one is very similar on the same lines. When should a member change their investment option or investment portfolio, e.g. at what age?
Well, I might start off by saying I don't think there's any magic formula that I can give you, but all I can say is as you get older, you probably need to be in a more conservative strategy for the reason that you've got less years ahead of you, more years behind you, less years to catch up any losses, and the risk that any losses will permanently affect your retirement income. In the case of Lifetime One, which is a strategy for before you retire, we change people's settings every year. The reason that we do that is it gives our members a lovely smooth glide path. I might move to the picture to show you. It gives you a lovely smooth glide path from something like 90% growth assets all the way down to about 40% or so eventually. But having this structure where every year I send you an email or I let you know that I've changed your risk profile is great for you because it reduces sequencing risk and big lumpy changes in your portfolio, but it also involves lots of work. So I think all I'd like to say is exactly the same as I opened with, and that is as you get older, one of the things you should take into account is your age and your longevity, and that you should probably have less risk as you get older. But there are also other things that might go into that decision. Maybe you should also take into account your salary, your account balance, and things like that. And we have every hope that we'll be adjusting Lifetime One to take account of some of those factors, because at the moment, the only thing we adjust is your strategy for age. The more information we get about a member, the better we can make the strategy and the more tailored and more customized we can make it for them, with the ultimate aim is if everything, went well, you can move towards having such a tailored portfolio that it's going to be a portfolio that's specifically designed for all of your circumstances. So that's the general situation, but generally, Australians have always drawn this artificial line at 60 years old because that's when they can get their money out tax-free. I don't think you should think like that. I think you should think that life is a continuum, starting at your first job and going all the way through. And so that means we can take you through from being someone who's young and wants a more aggressive portfolio, all the way through to retirement, during retirement, and even can help you down the track with aged care and things like that. So I hope that helps.
Thanks, Michael. We've still got quite a few questions to get through. The next one is probably advice as well, but I'll read it out. Through fear, I stopped my $600 fortnightly contributions and I've put that money into my bank account. How would you advise me? Thanks, Elizabeth.
Well, I think history has shown that when you get scared and you stop investing like that, it can hurt you because you're stopping your contributions at a time when assets are towards the cheaper end and offer great long-term value. So I really think the best long-term strategy is to find the right portfolio for you and to stick to it and to stay the course. It is a very, very hard thing to do, to pick when markets are cheap and expensive over short time periods and to adjust your savings. I totally understand that you got scared. We all got scared. We all saw our balances go down and were scared about our families and our jobs and the value of our assets. But I think the most important thing is just work out how much risk you're comfortable with. And our planners and our call centre can show you what would be the best strategy for you to be in. But certainly putting money in the bank, earning very close to zero, I can say to you that, as I said before, I can guarantee you that those assets will be very safe, but I can also guarantee you that that nest egg will not be growing and will be going backwards compared to inflation and your ability to buy things in the future. So I'd urge you to think about balancing those two things.
I'd probably also mention that maybe that member was salary sacrificing, and they could have been receiving some quite good tax advantages by contributing to the fund on that regular basis. So by stopping it, you're stopping the return that you receive by no longer getting that tax benefit. So there are ways and means of putting that money in and claiming it as a tax deduction. Depends on your age, and there's a lot of circumstances there, whether you're close to the cap. So I would ask that member to contact the fund on the 1300 number or their local regional manager. They can probably assist them with information, or otherwise we can put you in front of one of these limited advisors or over the phone advisors to get you that advice as well in terms of the monies that could have potentially been lost with the reduced tax savings as well.
The sort of thing that I think Paul is mentioning and I think would be very worth considering is we also have in superannuation some very good low risk strategies that will probably do better than cash in the long run. So you can get the double whammy of getting some tax advantages, having more money go to work for you, and probably earn a better long-term return than cash. For example, we have a strategy called credit income, which may be something worthwhile having a look at.
Yeah, and Michael, the website has the flexibility of leaving your assets where they currently are, but future contributions going to a totally new portfolio. So if you've got that comfort or got that worry about your account balances going backwards, well then these future transactions can go through to another portfolio.
And as our financial planning team always tell me, superannuation is just a vehicle to house your savings. You can choose whatever options and whatever assets within super that you like. And I would say to you, given that it's possible that superannuation pays a lower tax rate than you and you get tax advantages, it's probably a better place for most people to house their savings than in their own name. But again, your personal circumstances determine that, and I urge you to speak to a planner or someone qualified to give you that advice.
Thanks, Michael. Just so you know, we've got about 10 minutes to go. We've still got about 6 questions to get through so far. So if you've got any more questions, please put them through the feedback. That would be great. Oh, sorry, the chat facility. But the next question I'll give to you, Chris. It's about lifetime one, I guess. It's person just wants to clarify their own position. As a 50-year-old, I'm currently placed in 75% growth, 25% defensive strategy with balance changing each year towards defensive. Is that correct?
As a 50-year-old,
Yes.
you would be in, just trying to look at what we'd be. So I think you'd be
You're 100%.
100%.
It used to be called our growth portfolio.
Yeah, 100% balanced,
And it's about 75,
which
25.
is about 75-25, exactly right.
Yeah. So that's right. They will, as they get older each year, they're going slightly more defensive from age.
Exactly. So it roughly works out that on your birthday each year, you get de-risked by about 2% growth assets into defensive assets. And that's broadly how lifetime one works.
Okay, thanks, Chris. The next question is, do you have to opt in to the lifetime one strategy, or do you get moved over automatically?
Lifetime one is a default strategy. That means that if you don't tell us anything different, every person who's in accumulation, pre-retirement, will be in lifetime one. But we've seen both things happen. We've seen some people speak to a planner and choose their own investment options. We've seen some people opt out just because they want to. But we've also seen lots of people who used to be in choice assets, in others used to choose their own assets, say, oh, this is a great strategy. It automatically adjusts every year and it takes all the hassle out of my superannuation and having to think about changing it as I get older. And we've seen people move into lifetime one. But the short answer is it's an opt-out strategy. In other words, the fund will put everybody into lifetime one unless the member tells them otherwise.
Thanks, Michael. The next one is for Paul again. It's a similar question about the binding nominations, but I'll just read it out. Please, could you consider allowing members to make their binding nomination permanent so that they know their wishes will continue into any period of time during which they might develop dementia?
Yeah, we certainly will take that on board. The one thing that I would always say is that part of the planner's role is to look at estate planning, and there's wonderful things called powers of attorney and enduring powers of attorney. They're sometimes called different things according to the state you're in, but here in Queensland we have an enduring power of attorney. The power of attorney would be able to provide you with the binding nomination. So certainly we will take that one on board, and we will review that. But certainly I would ask and state that they're to get some advice, both legal advice as well as financial planning advice as to which way would be the best way to go.
Paul, is it fair to say as well that after the binding nomination lapses, it just becomes a non-binding nomination and the trustee would consider the previous binding nomination anyway?
Yes, that is correct. But obviously, you know, if you're hell-bent on having a binding nomination and making it sure it's in accordance with your wishes, especially in the case of dementia, I do agree with you, Chris, but this is a very complicated issue. And when there's money to be had, there's always a person trying to put their hand up. So I always say err on the side of caution and get some legal advice.
Thanks, Paul. I guess this could be for you, Paul or Michael. What is now considered the retirement age? As if you are 55 but not intending to retire until 70, does this mean because you're 55, you are nearing retirement despite intending to work for another 15 years?
The short answer is no. Lifetime one was designed with a retirement age of between 67 and 70. The fact that the age pension has been pushed out and will probably get continue to be pushed out over time. The fact that interest rates are so low that our retirement savings won't last as long as they used to, I think we're all going to find ourselves working longer than we thought. And you might remember at the beginning of this presentation, I said I'm 58 and think I'll probably work for another 10 years. So it's more likely 68 than the old 55.
And I suppose to also clarify is that we've got a number of different rules in regards to that. We've got the age of when you're eligible for the age pension. That currently is a moving age and will gradually be 67 years for all in a couple of years' time. You then also, and when I did the introduction, we talked about Michael meeting his preservation age. So that is when you can actually have access to your account. Presently, that is 58, and that too is also going to be moving to 60 years of age for everyone. So essentially, in a couple of years' time, everyone, if they wish to retire and cease work, they can have access to their superannuation at 60 years of age, but potentially they won't be eligible for the age pension until 67 years of age. So yes, I suppose there's a wonderful thing, we can retire whenever we like. It comes down to affordability. It also helps if you start buying the gold casket ticket every Saturday night. But certainly genuine retirement at 60 years of age, eligibility for age pension at 67 down the track in a couple of years' time.
Thanks, Paul. We've still got time, about 4 minutes to go and 4 questions. So if we don't finish them, we'll email you directly the response to the questions. But I'll just go quickly to Michael for this one. I'm 75, retired 1 year ago, and with consultation was set up with a retired choice pension. How is this different from Retire Smart being mentioned?
I think Retire Choice is probably a good thing for you right now, because at 75, I think you probably would like a lower risk than what Retire Smart currently is. Maybe in the future, when Retire Smart and the changes that Chris Drew has made make it applicable for everyone of every different risk option, that'll be something to do. But the advice that you've had seems at face value to be pretty good for me right now.
Thanks, Michael. The next one is, COVID-19 concessions allow retirees to reduce the minimum drawdown from 4 to 2%. I am 62. Should I utilise cash reserves for that top-up income and reduce to the 2% drawdown from my pension payment?
I'm going to give a very broad answer, but once again, shy away from giving personal and specific advice. All I can say is that I love superannuation. I work for a superannuation company, and it's hard to get money into superannuation. So if it makes sense, the more money you keep in super, the better. So if you're able to reduce your drawdown and you've got cash that you can use, that's certainly something I'd talk to a planner about as being a sort of way of keeping your super balance up. Because your super balance, especially if you're a pensioner, the tax rate on that's 0.
Thanks, Michael. The next question is, what happened to the socially responsible balanced option?
The socially responsible option has actually been our best performing option this year. It made 2.91% for the year to June 30. And we're very, very proud that you can not only do good, but you can also do well in terms of investment performance. And certainly over 3 and 5 years, it's been one of our best performing options. So it's got similar risk to a balanced fund, and it's been outperforming the balanced fund. And the main reason has been because it doesn't hold fossil fuels, and it does have a higher allocation to technology.
Thanks, Michael. The next question is, was there a significant drawdown on super by members due to government allowing early access? And has this impacted the fund's performance/returns?
The short answer is not at all. Our members are full-time school teachers or people involved with education generally. The numbers are public, so you can go look at them yourselves, but the total amount of money our members withdrew was less than 0.3% of our funds, and therefore was totally insignificant in terms of liquidity, returns, moving money around, or any of that. Even some of the funds that cater for younger members, like Host Plus and Australian Super, it was still less than 5%. So the press like to talk about this a lot. It really wasn't a major consideration at all for us.
Okay, I've still got 3 questions, and we're just hitting 7 o'clock, but I'll just quickly just give very short answers, Michael. At what age does ACSRF move a portfolio into lifetime one?
It's a default strategy, so it's not done on age. Every member, unless they tell us otherwise, who is still working, will go into lifetime one.
Thanks, Michael. Next question is, I am just starting to have my own business. Is it an option to put in, is it optional to contribute to superannuation?
Well, I'll take that question. That would all depend on the entity that you've got. If you're classed as self-employed, then it's obviously up to you. If you're employed as a director of a company and paid a salary, then there's obviously the compulsory superannuation requirements. It's a very broad question. I would probably say give me a call or contact the call centre. But for the moment, yeah, I would just leave it at that.
And the second last one is, I retired 6 years ago at age 70. Have I understood correctly that my portfolio is being adjusted automatically as I age?
No, and the short answer is because lifetime one, if you are still in accumulation at ages 70 and over, has exactly the same risk and the same proportion of growth assets. And if you are already retired and a pensioner, then it's wherever you choose. So no, we haven't adjusted anything after 70.
And the last one was, the advice is to go into more conservative portfolios nearing retirement age. But how close to retirement age? E.g., 5 years before you retire or 10 years?
Once again, I think personal circumstances should determine that. But certainly, as you get older, you should be in a lower risk strategy. As you get a higher amount of assets, you may or may not want to protect that. But please remember this. If you're planning on retiring, let's say at 65 years old, and the chances are that you're going to live to 90, you've still got 25 years of investing and having money in super to go, and you really shouldn't get too scared and go to 100% cash or anything like that. But what exact mix of risk assets, as in growth assets like shares and property and cash, that's a question for your personal circumstances. What I can tell you is that our members certainly are much more interested in speaking to us at around age 50 to 55, which is when they're within 5 to 10 years of being able to take their money out of super. Not, as Paul said, not necessarily retire, but eligible to take their money out.
Thanks, Michael. And the last one I had was just a person said they've arrived late to the meeting. Will it be repeated at any time? What I'll say is we will look at putting this on our website. We are recording it, so we will look to put it on our website. I know there's been a few people coming on late, and all the people who have registered, we will get you a link to watching this again at some stage. But just give us a couple of days for that one, and I'll arrange that. So Paul, can you just wrap things up?
Okay, well, thank you very much for attending, Justin, and helping us with those chat questions. Chris, thank you very much for the answering of a couple of the questions that you got your way. Michael, as always, it's always a pleasure to hear your dulcet tones in regards to investment performance. I know it's a significant passion. We've often driven to a good hour or so to a webinar or a live seminar and discuss these things. So thank you very much for attending tonight. Unfortunately, normally when we close seminars, we would probably say that we might all go out the back and have a glass of wine and a cheese and bicky, but unfortunately under these current times, it's webinar based. So tonight we can't enjoy your company, but certainly we wish you all the best for the evening. Some of you might have been fortunate enough to be eating dinner while we're going, but for those of us that will be certainly looking forward to dinner in a couple of moments. Thank you all very much for your attendance tonight's webinar. We wish you all the very best. Keep safe and well, and God bless. Thank you.
Thank you.
Thanks, everybody. Good evening and stay safe.